In this video, I break down section 121, the home sale exclusion, the rule that lets you exclude up to $250,000 if you're single or $500,000 if you're married, filing jointly when you sell your primary home. Most people think section 121 wipes out all the gain, but that's not always true. And if you ever rented the home out, things get more complicated. To make everything clear, let's start with David's real example. Alright, David bought his home in California in 2014 for $850,000. He made $40,000 improvements, so his adjusted basis before rental and use is $890,000. 2014 to mid 2020, that's the time that he lived in the home, over 6 years. July 2020 to December 2022, he rented it out 2.5 years. January 2023 to May 2025, lived in it again. May 2025, he sold the home. This timeline is important because section 121 uses a 5-year window. Rental years create depreciation recapture. Living in the home before and after renting still counts toward the test. Now that you know David's situation, the rules will make perfect sense. So section 121 lets you exclude gain when you sell your main home. Not a rental, not a vacation home, not a second home. And it never excludes depreciation recapture from rental years. To qualify for section 121, you must pass all 3 tests: the ownership test, the use test, and the look-back test. For the first one, the ownership test, you must have owned the property for at least 24 months during the 5-year period ending on the sale date. The 2 years don't have to be consecutive. You can add ownership periods together. Inherited homes get the previous owner's time. Living somewhere else still counts toward ownership. He owned the home from 2014 to 2025, way over 2 years. The second test is the use test. You must have lived in the home for 24 months, 730 days in the 5-year window. The months don't have to be back to back. Temporary absences count, like vacation, work travel, medical leave. You can move out, rent it, then move back in and still qualify. Spouses must both meet the use requirement to get the full $500,000. In the last 5 years before selling, May 2020 to May 2025, he lived there mid 2020, all of 2023, all of 2024, and part of 2025. Easily more than 2 years. So David passes the use test. Time spent renting does not hurt eligibility as long as you hit the 2-year rule. The last test, the look-back test, this prevents people from getting repeated exclusions too close together. Applies whether the prior exclusion was full or partial. If married, both spouses must pass to get the full $500,000. If you're selling 2 homes in 1 year, you can only exclude 1. David passes. He has never used the exclusion before. During the rental period, David had to depreciate the building. 80% of value was allocated to the building, $680,000. Depreciation per year was $680,000 divided by 27.5, $24,727. Over 2.5 years of depreciation, that's $61,818 of depreciation. Section 121 cannot exclude depreciation recapture. This part is always taxed as ordinary income and goes on form 4797. So David sells the home in May 2025 for $1,450,000. After $70,000 of selling expenses, his net sale price is $1,380,000. Now let's calculate David's adjusted basis after depreciation. His basis before rental and use was $890,000. That's the purchase price plus improvements. During the rental years, he claimed $61,818 of depreciation, and depreciation lowers your basis. So we subtracted $890,000 minus $61,818 gives an adjusted basis $828,182. Next, we calculate the gain. We take the net sale price of $1,380,000 and subtract the adjusted basis of $828,182. That difference, $551,818, is David's total gain before applying any special rules. Now we need to split the gain. The $61,818 of the gain is depreciation he claimed during the rental years. This portion is always ordinary income, and section 121 cannot exclude it. It will be reported on form 4797. Now take the total gain of $551,818 and remove the 61,818 of depreciation, what's left is 490,000 of long-term gain. And then this is where section 121 applies. Because David is married filing jointly, the section 121 exclusion is up to 500,000. Since the remaining gain is 490,000, the entire amount is fully excluded. That means there's zero taxable long-term capital gain. And because the home was a rental, 4 forms is going to show up. Form 4797, the depreciation recapture. Form 8949, that's the sale with exclusion adjustment. Schedule D totals the long-term capital gain. And Form 1040, the final tax calculation. An important thing to remember here is that because David rented out his home, it became Section 1250 property, which is the tax category for depreciable real estate like residential rentals and commercial buildings. When he sold a home, the IRS requires him to recapture the depreciation he took during those rental years. That recapture amount is taxed as ordinary income and goes on Form 4797. If he had never rented the home, there would be no depreciation and no Section 1250 recapture. So David's house was a rental, which is why he has depreciation recapture. A real estate recapture is taxed as ordinary income, not at the 25% special rate. The 25% rate only applies to the remaining long-term gain after recapture, but Section 121 excluded all of that. So David ends up with only the ordinary income recapture of 61,818 and no other taxable gain. So now let's start with Form 4797. Here's the simple explanation of this form. Form 4797 is the IRS form you use whenever you sell business property, and that includes rental property. If you ever took depreciation, the IRS wants to know how much depreciation you claimed, how much of it you must recapture as ordinary income, how much gain remains after recapture, and whether the leftover gain becomes Section 1231 gain that flows to Schedule D. Even though David's home is a personal residence now, he rented it out for 2.5 years. Because depreciation was taken during those rental years, the IRS treats part of the sale as a sale of business property. That's why Form 4797 is mandatory. So there are 4 parts of Form 4797. Part 1 is the Section 1231 gain. This is where long-term gains from selling business property go. These amounts naturally flow to Schedule D. David's remaining gain after recapture shows up here. Part 2, not relevant for residential rentals. This part deals with short-term 1231 activity or other uncommon business transactions. Most home sale cases skip it entirely. Part 3, depreciation recapture. This is where the IRS taxes the depreciation he took during rental years. David claimed 61,818 of depreciation. That entire amount becomes ordinary income. Section 121 cannot exclude it. Part 4 only applies when you use Section 179 or luxury vehicle depreciation and your business use percentage later drops below 50%. David didn't take Section 179 or vehicle depreciation, so all lines in Part 4 stays blank. So for David's situation, the only important sections are Part 3, the depreciation recapture, and Part 1, the remaining long-term gain. The key point most people miss is that Section 121 excludes long-term capital gain. It does not exclude depreciation. Now that we understand how Form 4797 works, let's fill it out exactly the way the IRS requires for a personal home converted to rental and then sold. Alright, for a rental property or any home that was depreciated, you always start with Part 3. Part 3 calculates the depreciation recapture. Then whatever gain is left flows up into Part 1 as Section 1231 long-term gain. Line 19A is just the description, residential rental property, former home. Line 20 is 1,450,000. That's the gross sales price, not the net sales price. Line 21 is 960,000. Basis before depreciation. Line 22 is depreciation taken of 61,818. Line 23 is the adjusted basis, 898,182. Line 24 is the total gain, 551,818. Line 25A and line 25B are both the depreciation recapture amounts of 61,818. This amount is ordinary income. Section 121 cannot exclude it. And for the summary, Part 3, line 30, the total gain is 551,818. Line 31 is the recapture, 61,818. Line 32 is the remaining Section 1231 gain of 490,000. So Part 3 gives us the 61,818 of recapture and the 490 that flows to Part 1 as long-term gain. Part 1 is where we report the full gain before applying section 121. So we only fill part 1, lines 2, 7, and 9. Everything else stays blank. Line 2 is the property description. And then we have the date acquired and date sold, and the gross sale amount, not the net price, is $1,450,000. Depreciation allowed is $61,818, and $960,000 of costs or other basis plus improvements and selling expenses. So Form 4797 calculates the gain using the gross price. $1,450,000 minus $960,000 is $490,000. Then you add back depreciation because it was previously deducted. That's the $490,000 plus $61,818 equals $551,818. Line 7 is just combining lines 2 through 6, $551,818. Line 9 is just subtracting line 8 from line 7, the same $551,818. The $61,818 of depreciation recapture doesn't show up as its own line on the Form 1040. It flows through Form 4797 and Schedule 1, and then ends up included inside David's total income on Form 1040. And the remaining long-term Section 1231 gain of $490,000, and that's the total gain of $551,818 minus the recapture of $61,818. This is what would normally flow to Schedule D, but David is married filing jointly and passes all Section 121 tests, so Section 121 exclusion for him is up to $400,000. His entire $490,000 gets excluded later. Only the $61,818 recapture remains taxable. So just to be clear, Form 4797 does not apply the Section 121 exclusion. It only does two things: taxes the depreciation recapture, sends the remaining long-term gain to the next form. One thing that's really important about Form 4797 and Form 8949 and Schedule D is the numbers are going to look a little bit different because they're doing different jobs. Form 4797 treats the home as business property, so it must start with the gross sales price, the full amount before commissions or selling costs. Those selling costs get added into your basis instead. Form 4797's job is to calculate the total gain and pull out the depreciation recapture, which is always taxable. Once that's done, only the capital gain portion goes to Form 8949 and Schedule D. Those forms don't redo the sale. They only report whatever long-term gain is left after recapture. That's why they use the adjusted numbers and show the Section 121 exclusion, wiping out the gain. So some of the amounts on Form 4797 won't match the amounts on Form 8949 or Schedule D. Alright, now we're moving on to Form 8949, which is the form the IRS uses to report capital gains and losses. Even though David is using Section 121 exclusion, the IRS still requires us to enter the sale here because this is where the exclusion is actually applied. Part 1 of this form is going to be blank because it's only for short-term transactions, assets held for 1 year or less. David owned his home for more than 10 years, so this is a long-term sale, not short-term. Part 2 is for long-term transactions, meaning anything owned for more than 1 year. This is exactly where David's home sale belongs. And here you see 3 boxes, D, E, and F. For home sales, you always check box F, long-term transactions, not reported on Form 1099B. That's the correct box because home sales use Form 1099S, not 1099B. Now we enter David's home sale on a single line, the description, the date acquired, date sold, the sales price. This is the net sale price after subtracting selling expenses, $1,380,000. Column E is the cost or adjusted basis. David's basis was $890,000, and we subtract the $61,818 of depreciation that he claimed during the rental years. This gives us an adjusted basis of $828,182. For column F, we enter code H, which is the IRS code for the Section 121 home sale exclusion. Column G, adjustment amount. The long-term gain after recapture is $490,000, and the exclusion removes all of it. So for column G is negative $490,000. This wipes out the taxable capital gain. Column H does not include depreciation recapture. That part was already taxed on Form 4797. Form 8949 only handles the long-term gain, and because Section 121 excludes all $490,000 of it, the final amount in column H is 0. This shows the IRS that the gain is completely excluded. Line 2 at the bottom, the totals, Because David has only one long-term transaction, the totals are simply the same numbers repeated. These totals flow directly into Schedule D, where the IRS will see that David has zero taxable long-term gain. Now let's go through Schedule D. At the top, Schedule D asks whether you dispose of any investments in a qualified opportunity fund. David didn't invest in a QOF, so we check no. This has nothing to do with the home sales, and we move on. Now here's how the Schedule D columns work. Column D is the proceeds, the sell price. Column E is the cost or other basis. Column G is where the adjustment from Form 8949 goes. Column H is the final gain or loss. So we transfer the proceeds and basis from Form 8949 to Schedule D. Line 8B. Notice that on column G on Schedule D is grayed out. That's because Section 121 exclusion has already been applied on Form 8949. Part 1 is for short-term capital gains. David didn't sell anything short-term, so we skip this entire section. Line 8A is the simplest category. If your brokerage reported the correct basis to the IRS and there are no adjustments, the sale goes on line 8A. This is for simple stock or crypto sales, where the broker reported the basis to the IRS. There's no wash sale, no corrections, no adjustments, no special codes. Because David had an adjustment, the Section 121 exclusion, line 8A must stay blank. Line 8B is for long-term transactions with adjustments. This applies when the sale required an adjustment code in column F on Form 8949, an adjustment amount in column G on Form 8949, basis not reported by a broker, and Section 121 home sale exclusion. David's sale qualifies because on Form 8949, it shows we entered code H. Schedule D never repeats adjustments. It only receives the final gain or loss. So even though we entered a negative $490,000 adjustment on Form 8949, we do not enter it again on Schedule D. Column G here is locked because the IRS wants all adjustments handled on Form 8949 alone. Schedule D only pulls the final gain after all adjustments, which is 0. Alright, moving on to page 2, part 3. This is going to be completely blank. Page 2 of the Schedule D is the capital gains tax summary, but it only does something when there's a taxable capital gain. David's long-term gain here is 0. 0 is not a gain. David has no 20% collectibles, no unrecaptured Section 1250 gain, no capital gain tax to compute, no loss, no dividends tax at lower rates. And so this is the final flow. Thanks for watching. We'll see you in the next video.